to our first ever online preferred shareholders annual general meeting for Advanced Mortgage Investment Corporation. My name is Anisa Lancione. I'm a dealing representative with Advanced Capital Corporation. As many of you know, Advanced Capital Corp, or ACC, is the agent and dealer for Advanced Mortgage Investment Corporation, which is the issuer. And every year we have to review the issuer for suitability on our product shelf to make sure that it still remains a viable investment offering. So even though we're a captive dealer by virtue of common ownership and control, we still have to perform this exercise every year. And we thought that, largely due to COVID and because we're not having as many in-person meetings with our existing shareholders as we usually do, that we would open this conversation up to our shareholders to join us and participate in this conversation in real time. And then also make it available as a recording to share socially with our investors to make sure that those who couldn't attend at this moment can still benefit from the information and hear the kinds of questions that we're asking ourselves and that you're asking us about the issuer. On the call with us, and just taking you over to the slide deck here, we have Michael Hapke, who is our President and CEO of Advanced Mortgage Investment Corporation. Mike, sound check?
Yes, I am here.
Perfect.
Dressed kind of like Santa Claus today, but just realized got my festive red jacket on, so ready to go.
Awesome. And then also on the call with us, we have the members of the Advanced team, Isabelle Anderson, who is a dealing rep and chief compliance officer for the companies.
Hi.
Perfect. Jennifer Anderson, who is our manager of investor relations. She's also a registered dealing rep, and she's also a licensed mortgage broker. Jen?
Afternoon.
Perfect. Andrew Maliero, who's our operations manager and has been with the company now longer than I have, and handles all sorts of compliance and accounting and default management. And Andrew does a lot for us that I think kind of goes on behind the scenes. Andrew, say hi.
Hi, everyone.
Perfect. Marvin Cajina, who is our CPA CA, one of our most recent additions to the team, who's made one of the biggest differences. And Marvin is our Director of Corporate Finance for the companies. Marvin will be primarily responding today regarding the financials. And he possesses a granular knowledge of any small, minute, and also large and important financial matter. Marvin?
Good day, everyone. Excited to be with you guys and answer any questions that you have. Thank you.
And Daniel Bissex, our newest member of the team, who came on board, I think, in March this year.
That's correct.
Yeah, so Daniel has been working with the remainder of the staff in terms of transforming our lending model and our operations to match up with the new reality presented by COVID. So that's the team that's managing the MIC on a day-to-day basis. And we'll be answering our questions here today.
And Anisa, I should point out the Andersons. There is no relation between the two Andersons, but oddly enough, my son's first name is Anderson, so I must have a tendency to hire Andersons. So yes.
Okay, so what we'd like to do is make this an opportunity to have a conversation about the MIC's results and performance over the last year, how it compared to prior years, and what we're looking at for 2021. November 30th was the end of our first quarter in fiscal 2021. And so some of the data is being presented as at year end, and some of it's being presented as at the end of the quarter. And the reason why that occurs is certain data points keep moving forward. So when we can correlate it back to the financial statements, we're doing so, but when we only have a current data point, we're reflecting the current data. And okay, great. So I just need to make sure that we disclose that we cannot guarantee a rate of return, and that past history cannot be indicative of future performance. And that while our primary goal is preserving capital, we're also seeking to return to our investors an individual rate of return of between 7 and 7.5% net per year after all expenses. Our dividend rate is not necessarily the same as the individual rate of return. And I think that existing shareholders would have received their Q1 reporting, which explains the difference between the dividend rate and the IRR, in that the dividend rate is dollars per share. And every month as we receive new investors and as we reinvest dividends, the shares grow. So the dollars per share go down very slightly, whereas the individual rates of return are maintained. And that's the difference in the spread there. We're always happy to to dive into that with you because it can be something that people ask, why our dividend rate is different than the IRR, and that's the reason why. So as of November 30th, which was the end of Q2, our total distributions per share were 46.71%. And we make that information available to you, but we also post it to our website. And I'm just clicking over to the website and showing you where to find that. So those who are interested in how we're performing can visit the AMIC website, and under investing in AMIC, the dividends per share are disclosed every month in the same table that we're showing you in our PowerPoint. Is everyone able to see that? Please nod for me.
Yep.
Okay, so that information is always available. In March 2020, we increased our monthly dividend. We increased it from 4.5 to 5% per year. And that's the monthly dividend rate that we're paying out ahead of the top up. And I think I'm just gonna hand it over to Mike and Marvin to explain why we made that change.
Yeah, so Anisa, since inception, you will find MICs out there that sometimes will distribute 100% of their monthly dividend. We've opted to control it a little more because what we've seen in the past is some mortgage investment corps have actually over distributed. So what happens at year end, if they were paying, let's say, a dividend out, ours is 7.45. If, for example, we paid it out at 7.45, and then at the end of the year, once the financials are fully audited and you're falling short of that number, there may be a reason to either claw back some of what was already distributed or reduce the unit value. So in order to prevent that, we wanted to make sure that it was a very manageable number. And so 5% seems to work well. We started off with 4.5, and as you can see on the screen, we changed March 1st, 2020 to 5%. And the reason for doing that was simply to allow a little more compounding. We also have some investors that prefer to get their monthly dividend as well. So this allows us basically to distribute up to 5%. Will we look at changing that and increasing that in the future? It's fully within our possibility to do that. So if we see consistency north of that number, then there might be some comfort to move it up. At this point in time, we're liking 5%, and it seems to be a good number that our investors are comfortable with. So.
Okay, thank you. All right, so I think that we've covered this off, so I'm going to move on to our next results slide. And these are just some high-level data points about how the MIC is performing. And so this is as at the end of Q1 2021. We prepare these statistics monthly and post some of them on the website. And just taking you back to the website for a moment, so that every month, and you can check these numbers as we're updating them in real time. Here, where it says portfolio statistics, the table is here, and these data points are updated on a monthly basis. The board of directors is reviewing these monthly, and we report them to shareholders quarterly, but it's always here every month. Isabelle is the person who primarily updates this in tandem with Marvin based upon the data that is collected from the portfolio. So as of November 30th, the weighted average interest rate of the portfolio was 8%. And while that's still a very solid rate of return on interest only, that doesn't include any sort of setup fees or retained fees that the MIC earns over and above the rate. I have to note that when I look back at the chart here on the website, that 8% is the lowest weighted average interest rate since this chart has been prepared. I'm very interested in knowing if that's a reflection of market conditions or changes in our lending stance, portfolio composition. I'm interested in hearing more about this.
Yeah, so let me jump in there, Anisa. So just two things. First, the information that you see on our website, as Anisa has mentioned, we update this in real time each and every month. That is somewhat different than a lot of our competitors out there as well. And it's really, really important to us that there is full transparency. One, quite often, these are going to be questions that investors will call with anyways. Two, it's a compliance piece that we like to basically show the Ontario Securities Commission that we are completely being transparent with respect to updated information in real time. And so for us, it's very important that we're always sharing that information with you. And the other piece is it cuts down on some of those direct calls to us on a regular basis. So it works very well for us to just take this information, treat each month end like a year end, and put it out on the website for everybody to see. That's our investors, our competitors, whatever it is, it's all there for you. With respect to the rate of return, Anisa, I think one of the important, the biggest factors with respect to the rate of return, are there competitive pressures right now? There are some, because what's happening is because money is very cheap right now, there are some mortgage investment corps that are getting additional credit facilities at very low rates. So what that does, it allows them to actually drop some of the rates that they're charging to consumers with respect to private funds. However, some of these mortgage investment corps are not true mortgage investment corps anymore. They have the shell and the appearance of a mortgage investment corp, but those funds come with a lot of rules attached to them. So they basically don't have the flexibility that we do to really personalize and shape any particular deal. But more importantly, what I would say with respect to the rate of return over time, slowly going down, and what you've already pointed out is that this rate of return is just the coupon on the mortgage. It does not include fees. Okay, so the setup fees, the renewal fees, any NSF fees, which is not very large in our case because we don't have a lot of NSFs. And more importantly, it does not include churn. So I think we'll get into this a little bit later, probably in one of the other slides, but our average term to maturity is about 14 months. Why that number is so critical to us is that we always look for short-term deals. We want a deal that's coming in, we're fixing a particular problem, and then they're paying us out. I don't want to sit on money for 2, 3, 4, 5 years. I like to approve the deal, get the deal funded, fix the situation that we're dealing with, and then have them move out. So is 11 months better than 14? In our opinion, no. 14 is perfect. Why? Because they pay us the renewal fee at a maturity, and then we get to turn around and lend that money out again. So what happens is you might see that weighted average rate of return go down. All that tells me personally is the quality of business that we're doing is second to none. The quality is extremely high. So we're talking about average credit scores. So if you're not familiar with credit scores, and I think you've got it on the other screen, Anisa, we're sitting at about a weighted average of about 713, which is very, very good. So as you can see on the scale here, it's a bankable credit score. Banks will touch anywhere between 600 to 650. So these deals that we're doing, why aren't they with the bank if their credit score is so good? Because there's something about that particular deal that just falls outside of their lending criteria. And some of the lending criteria these days are very, very strict. We like it. We like the loan to value. We like the credit risk. We like the income, whatever it is, we can still do it because we are a private entity. But I would say the reason why you're seeing that overall rate of return just on the coupon going down is because the quality of business that we're doing, and because it's so good, we're able to churn that business on a regular basis. So I hope that kind of answers the question there, unless somebody else has got something to add.
I did want to just reiterate what you had mentioned, which goes back to Anisa's question where she's asking, is the interest rate downward pressure going to impact AMIC? And I think you've answered it very well. The turnover will obviously increase our margins. And also it's the lending fees, as you highlighted, because we can do it quicker and have good pricing strategies. I think we're able to offset that pressure.
Yeah. And here's what I'll also add. We won't chase the market. Okay. It's something that we're simply not interested in. So, we are not pushing, additional funds out, higher, riskier deals, more second mortgages. We're not going to chase return. So if it means the rate of return comes down slightly, we're okay with that. We target between 7 and 7.5%. We still feel that we can be successful in that range going into our fiscal 2021. But we certainly, even during the pandemic, and we actually ended up sitting on more cash reserves than perhaps we would have liked to, but we took a pause. We wanted to see what was going to happen in the market. We wanted to see whether or not any of our investors were going to have COVID-related events and need access to liquidity. As it turns out, they did not. So we were very fortunate in that respect. But we won't push money out the door and chase return. So if it means the rate of return comes down slightly, then it will come down slightly. But having said that, we don't anticipate that. I haven't seen any signals of us having to reduce our expectations at this point in time. And if I do kind of get those signals, we'll certainly make sure that we update our shareholder base through one of our monthly updates.
So you've touched on a lot of points there that we are going to dig into a little bit more during our conversation today. But one of the items that you just mentioned was the impact of lending capacity utilization upon our investor rate of return, right, on our gross income. So I just want to first off cover off the fact that, as you said, all of the fees levied to borrowers are earned by the MIC, right? So the MIC receives 100% of the income related to the loans. And that is different from some other mortgage investment entities that will peel off the fees and earn the money to their investors only through interest. So that hasn't changed.
Excellent point.
There's no plans to change that in the
No.
Okay.
No, there isn't. Yeah, that is very unique in our space. A lot of MICs will keep that setup fee, and that is a way they generate additional revenue over and above their management expense, disclosed management expense fees. We thought from day one, everything goes in, and here's what we get paid. Here's what you make. Here's what we make, fully disclosed.
So speaking of what you make, so I know in reading the financial statements that you took a bit of a haircut on your management fee revenue this year.
Yeah,
so,
can you tell?
Yeah. So it looks like you wrote down about $40,000 in management fees to which you were entitled, and that in the offering memorandum, that is a right that you possess as the company. You did that in the first year of operations, I believe. Back in fiscal 2014, and then recovered it in 2016 through IFRS conversion only, which was nice. And now we've taken this right down again. You should get paid to work, but how often will you be reviewing that and revisiting that decision as COVID continues, right? So as we continue in COVID, do you think it will happen again?
I want to make something perfectly clear. I do not want to do that again. We don't like writing down fees, but here's why we did it. None of us could have predicted, this pandemic and the outcome, and the reason why our rate of return was a little bit closer to about 7.1 prior to our write down of about 40,000, I think it was, something like that. Anyway, so prior to that write down, we looked at this and when March 13th hit and everything was kind of like, what's going on here? What's happening? We decided to, not press stop, but just press pause with respect to some of the lending activities.
Right, and we see that actually. You see that on the screen share here. I'm going to try and highlight June 30th, 2020. So I typically describe a MIC lending process as about a 45-day process. So from the time that the funds arrive or the application arrives, it's about a month and a half to deploy. So when we're looking at June, we're looking at the cash flow position that you were in mid-April, right? So just at the time that you're describing, when you decided to kind of take your foot off the gas a little bit. So that dip in utilization was the time when you were first assessing the impact that COVID would have on your cash flow. So okay, sorry, keep going.
Yeah, no, so that great point to highlight, Anisa, because when we basically took a pause, it was like, okay, a couple things. One, as I had mentioned already, are any of our shareholders going to have a liquidity event? For example, if they hold a large stock portfolio and perhaps they're trading on margin, they might actually have some margin calls. So, we do have our redemption policy with respect to whichever quarter you give us notice. We have until up to the end of the next quarter to actually fulfill that. However, we did not want to be in a position where we had to make people wait if they really needed their funds. We had one particular investor who had his own business and he had prepaid services to individuals. And those services were not going to happen anymore. So he had to pay all those individuals back. Well, he had already either invested or spent some of those funds and needed access to that capital. So we had very, very few redemptions, but it was nice that we were able to say, yes, we can actually fulfill that for you a little sooner than we normally would. So one was for the liquidity and making sure that our shareholders were taken care of and well positioned in the event they needed to make a redemption. And number two was we wanted to see what was going to happen in the marketplace. Like, was it going to affect real estate values? What's going to happen with employment? Now we've got a clearer picture. And of course, we know there's an impact from COVID, but we also, and from the pandemic, but we also know how Ottawa is responding to the pandemic. And, based on everything that we've seen so far, we can now comfortably say that we are more confident than ever with respect to the class that we are invested in and the city that we are invested in, and the way we do business. So that pause, basically, we said, hold on. So that meant we were going to have $2, $3, $4 million sitting in the bank account. When that money is sitting in the bank account, it's not working for our investors, not working for me. It's not working for you. But it was an important, a thing to do at that point in time, and it was a prudent thing to do. And we did discuss this with our board of directors as well. And then we said, we had 4 million, we're going to bring that down to 2, and then we're going to bring it down to 1. So we slowly started to push those funds out the door again, and approve deals. But I wanted to basically turn around at the end of the day, and instead of 7.1, we had, I think it was roughly $400,000 that was redeemed.
Yeah.
In total, because of a COVID event. We raised during that in the past year about 8 million or 7 million, somewhere in that neighborhood. Over the past 12 months, I wanted to basically reward those individuals. We had told them going into this that they can expect between 7 and 7.5. So we would have been well within our wheelhouse to say 7.1. But I thought it was the right thing to do to push some additional management fees out the door. And we were happy to do it and reward our investors for it. So
I think you had 8 redemptions during fiscal 2020, that were non-RIF minimum annual payments. I think it was 8. Isabelle, am I right or wrong? I think we just...
It was, yeah. So, there was only two. There was only 2 COVID related
There was
redemptions.
only 2 COVID related.
Yeah.
The other ones were either people purchasing,
Correct.
so they needed access to the funds. I'm having
Yeah, I've got
trouble
them in front of
remembering
me.
8 of them.
One TFSA over contribution of a very small amount.
Yes, that was a very small amount. Yes.
Right. We had a full redemption related to someone who received a bequest and had to transfer all of their holdings to a trustee that doesn't hold mixed shares.
Mhm.
The 2 COVID, the guy who had to repay
2 purchases.
And then 2 people who were purchasing other properties, one of whom has now fully reinvested the money that he withdrew.
Yes.
I know
That's correct.
Yeah. So that one was that one was the largest one. That was 150,000 that was redeemed, and those funds have since come back in. So
okay. So in terms
after the
of
purchase,
people, in terms of people choosing to leave the MIC because of concerns over COVID, there were 2 investors who.
2, yeah. And in fact, when I took the time to sit down, so when COVID first hit, the best thing for me to do at that point in time was pick up the phone and just speak to every single investor. So they either got a message from me, a voice message, and some would call back, some wouldn't. But I just basically worked the phones and I went down the list. And through that process, we ended up raising another 300,000 or 400,000 just from making those calls. And then we turned around in June and had one of our biggest raises that we've ever had.
So here we are. I'm gonna stop you there. You're right.
Sure.
You guys have had an amazing year for fundraising, especially given the market conditions. And I know that by publishing your COVID updates on the website, you kept current shareholders as well as prospective shareholders fully informed every month, right? So I know that it's been dialed back from monthly reporting to quarterly, but still keeping that COVID related conversation going on, which is cool. But COVID has had a bigger impact, I think, on origination. So one of the things that I've observed over this, the last 6 months of fiscal 2020 and the first quarter of fiscal 2021 is a very, very slight change to your lending strategy in terms of what I might term like an Ottawa Plus expansion with some very, very slight increases just outside of Ottawa into a new lending area. And I'd be interested in hearing from you and Jenn and Daniel about how that's working out, and if there are qualitative differences between that slight broadening in lending area and the existing lending area. I'm just going to pull up my my PowerPoint slide and jump ahead a little bit to that particular. Here we go.
Yeah, for sure.
So we've added some colors.
Yeah. So, so we have always been kind of Ottawa centric and an Ottawa MIC. We've always said all along that we don't mind kind of looking, to the outskirts a little bit. And so what we've basically seen here, and keeping in mind the credit score, and so for that segment of other than Ottawa segment that we see there, the as you can see that the weighted average credit score is actually the same, 712, 713 for all of them. So the credit scores are still excellent. But what is what we're looking at when we're looking at these particular properties is if there's scenarios where there's extremely low loan to value, great property, great borrowers, we'll still look at it because we can still charge that premium. We can open up and expand a little bit. But the weighted average loan to value on those particular funds are at 67%. So, so we're being more conservative in those areas. We don't have any plans to going to Toronto or going out west or Quebec or whatever it is. But these are still good quality properties, very low loan to value, and deals that, quite frankly, we just really liked. So, so we did expand that and open that up a little bit. But it's still a very high quality of business that we're doing there.
And in terms of property type, AMIC has traditionally been a residential mortgage lender. I think that we've seen a couple inter alia or blanket transactions that you've put on the portfolio this year, where you're blanketing, and by that you're placing a mortgage on a property that might not be residential, but that you are securing it with a mortgage that's on a residential property that's more an AMIC's traditional bailiwick. And I think that there are two.
You got it. Yes. Yeah, there are two. So we will look at, so we are not a quote unquote commercial lender. We know how to underwrite commercial because we are all mortgage agents as well. So we fully understand, the nuances that come with commercial lending. But we will entertain, for example, if we see a nice commercial property, loan to value is excellent. We like the commercial space. We're not talking about, environmentally sensitive type commercial properties and whatnot. But if we have a good equity position in their principal residence, then we'll look at it and say, listen, we could just simply be lending them those funds on their principal residence. So we take both properties. So we'll take the commercial property as well as the principal residence. As long as we're in a good equity position on that residential principal residence, then we will consider those types of deals. So we don't have a lot of them. I think we've got, like you said, 2, I think, on the books. But those are also good opportunities where, we can act as a mortgage investment corp. We can act a little differently than your traditional bank lender, and we can create products for borrowers.
I'm going to pivot to performance on those mortgages, and I'm going to back up here in the presentation to look at our NSF history. With those mortgages that are non-Ottawa, and that's what we're going to call that block is non-Ottawa, how are they performing in comparison to the Ottawa block? We didn't specifically prepare that for this meeting. Sorry, Mike, curveball. Jenn, Marvin, Andrew, are those mortgages any different in terms of how they're performing?
I can speak to that. No, never a problem. All payments on time. No NSF history. No, not a problem with those ones at all.
Excellent. So the slide that we're looking at right now is the repayment history of the borrowers that are currently on the books with Advanced MIC. So these are borrowers who currently have mortgages with the MIC as at August 31st, and this is their NSF history. So what we're seeing is that 97.15% of the borrowers as a percentage of the total portfolio have never had an NSF payment. That 2.71% of them have had one NSF. So, and then 0.14 have had 3 or more NSFs. And I think I remember who that is, but your borrowers don't tend to miss payments. Has this changed at all during COVID?
You know what? I hate this screen because to me, I'm looking at those NSFs and it's like, oh, red flags, right? The answer is no, it hasn't changed. In fact, we have a incredibly clean history of very, very few NSFs. In fiscal 2020, we had 4. And I remember one of those was a scenario where funds simply weren't cleared. So the individual had made the deposit, but it was still on hold. So the payment didn't go through. And the remainder were brought up to date, typically within the next day. Sometimes, the day we call them, they're in and the funds are deposited. So, and the only reason why like each and every month, we send out to all of our team here an update daily, for the first 15 days of the month, saying, hey, like any NSFs come, here's what came in, or here, it's clear, there's nothing there. But yeah, we don't like NSFs, and typically when we do see them, it's for a particular reason. And we had one recently that wasn't in fiscal 2020. It was just recently where on the renewal of the mortgage, the payment went up slightly. So the individual didn't plan for that increase or missed it, and so the payment came back because of that. But the non-payment, there is one individual who has missed a couple payments and not they're not continuing to miss payments, but an NSF, and then we get the payment, NSF payments, and this individual has been laid off, and they're in the service industry, and so in that scenario, we're in a very good equity position on the property. We've got more than ample security on the property, and we always register as well for 115% of the mortgage amount lent. And that's an important piece to note. So we always have space to actually cover some payments because we've already registered for the higher amount. And in this particular case, we're just letting the individual know that, you've got 3 months, find some alternative financing, because we really are, and it might sound a little tough, but, for us, we are a very, very clean mortgage investment corp. I don't want to spend valuable resources on having a department that just does collections full time. We know how to do it. We do have to, make those calls from time to time, but I don't want a collections department, and I don't want a legal department to be following up on these. So for us, it's time for that individual to move along, and they will get financing. There's no question about that, simply because the loan to value is so attractive on that particular property. So we don't have any issues with respect to NSFs, and it's always a monthly, event that we look forward to seeing those zeros. So that's our goal.
And then at the height of COVID, how did you guys make out? We know that the banks were offering, structured deferral programs. Did you have any borrowers that were seeking payment relief? And if you did, how did you handle that?
I don't like the word deferral.
I didn't use it in relation to you. I said
I know you didn't. I noticed that you did that. There is no deferrals. We don't defer payments. So, and the reason why it's important to note, the reason why we are not deferring payments, we've got the ability. So we only lend at very attractive loan to values, and then we register our mortgage amount. In the past, we were 110. After the COVID event, we've moved that to 115. So anything that we do, we register for 115% of the actual advanced mortgage amount. So in the event they have a COVID event, and they need some short-term relief, we want to be able to say, that's okay, no problem. We don't want to come down with a hammer on them and, kick them when they're down. We want to be able to say, no problem, here, we can advance this amount, and now it goes to your balance. So just take the next month, like we've covered it, because we have the ability to do it. And that has proven very successful for us, just basically working with the borrowers, and kind of helping them through these types of scenarios. Now, we haven't had very many of them, but we do have a couple where we've been able to help them out, and keeping in mind as well, for the MIC itself, for our investors, it's actually it has a net positive effect, because now it just increases our portfolio by that small amount. But so from an investor's perspective, we're not deferring anything. It's not like pay me later, and you're going to have a holiday here. It is, we've just added this amount to your balance. So.
Okay. Will you be continuing to update that information on the COVID page as things continue on a quarterly basis in terms of any payment relief options that you exercise?
Absolutely. Yes.
Perfect. What about insurance? Have you seen any? I'm curious about how COVID has impacted borrowers' fire insurance, which is required on every transaction. Have you seen any changes to the insurance that your borrowers are able to get during COVID? Has that changed in any way?
Jen, do you want to jump in there?
We haven't noticed anything. There's been no limitations to any of the fire insurance policies that we've seen coming in, so no.
And in terms of cancellations, there hasn't been like a huge surge in policy cancellations for non-payment?
No. None.
Yeah, I know where you're going with that, Anisa. I know that some insurance companies have gotten quite nervous about certain industries with respect to they might not have any other options, than perhaps, having their business or whatnot, burned down. And so these are real, facts that we're dealing with during this pandemic now. It's not simply our market, so we haven't seen any negative effect with respect to insurance cancellations or anything like that. So, or people.
I feel like this is a good point at which to segue over to second mortgages. So when we look at the performance chart on the website, we see that in 2018, if you look at when we started tracking this data, we had about 40% of the portfolio in second mortgages, and that has come down nicely to the 25% range that we target in the offering memorandum.
Yep.
I know that it can be challenging to get borrowers to provide information midterm, right? But because all of AMIC's paper is written on a one-year basis, you have an opportunity every year to determine if these borrowers have maintained their first mortgage. I know that if the first mortgage falls into serious arrears, you're notified. But if the borrowers make a payment arrangement with their first mortgage holder, you don't necessarily hear about that until your renewal date comes around. So have you found that any borrowers who have renewed entered into deferrals, and did that impact AMIC's position or loan to value at all?
No, we haven't. So, we do basically, and of course, since March, our renewal process, I would say, has probably changed slightly with respect to just how much due diligence you do at that renewal point. You want to make sure that there are no deferrals. Are there any changes with respect to their credit? Are we moving in the right direction? So renewal is a very, very important process now, where maybe before it was a little easier to just kind of, get that renewal out the door. Now we're doing a deeper dive on each and every file to make sure that, we're still comfortable, with that particular file. And if we're not, then we simply let them know that we're not in a position to renew. So, and we have had a couple situations like that. I mean, nothing, terrible, but I mean, just we really do focus on, the top, cream of the crop here with respect to borrowers, and we are not at the bottom of the food chain as a lender. So it's very important to us to make sure that the people that we're lending to are good quality borrowers and ones that we are aiming to move out, because that churn is important to our portfolio as well.
Speaking of which, I know, Marvin, that you've done some work on determining your renewal rates versus your discharge rates to try and project what your reinvestment rates would look like. Would you say that AMIC has seen a greater rate of discharges versus renewals in the last fiscal year versus prior years?
I don't think the rate has changed. I think the dollar size has, just because of the growth factor. And this kind of goes back to your point about, for example, insurance cancellations. So we had 5 of them in fiscal 2020. And the beauty about having such a great turnover is that 4 of those 5 are actually discharged now, and we've collected all of the funds. So in general sense, I haven't seen there to be a rate difference with a lot of our numbers, just more dollar wise because of the growth factor. But that's the beauty and ironic thing about having high turnover, because what happens is you almost wipe your slate clean with your new borrowers, and that's the beauty about having that type of business.
So speaking of differences year over year, when I'm just going to grab over to the financial statements for a second here.
I just wanted to, Anisa, before you flip off of that,
yep,
can we discuss? I wanted to talk about the weighted average, the loan to values, and the differences, if that's okay.
Sure.
So with respect to the weighting, with respect to first to second, so as you can see, back in December 31st, 2018, we are like, I mean, it's changing, right? I mean, we're becoming more heavily weighted towards firsts than seconds, and that again is going to have impact on that weighted average rate of return. That is one of the factors for sure, because of course we price first lower than we do seconds. It's also a product of the growth of the fund, and I think Marvin was just alluding to that. So when you have smaller dollars to play with, you typically tend to do smaller seconds. And then once the cash flow and the investments start flowing and they're heavier, you've got the ability to still do quality deals, but the value of those deals does increase a little bit. So going back year over year, it was about $100,000 difference with respect to, I think it was 106, with respect to the average first mortgage and the average first mortgage compared to 2019. So the amount had increased about 100,000. It increased about 58,000 on the second mortgages. So you're going to see, because we have more funds available to us, because we've got that churn happening, we've got the ability to look at larger first mortgages now than we did before. Important to note, we don't like large second mortgages behind large first mortgages. It's just not something that we try to steer clear from. We also don't look at we don't like high-rise condos either. So one of the pieces that is always been on my radar is typically the condo market, and we're seeing it firsthand right now in Toronto. The condo market is always the first one to start to soften, and so what we're seeing there is that condo market softening. We don't invest in the high-rise condo market in Ottawa, so we are looking primarily.
How many condos do you have right now? I'm sorry, just nipping in.
I'm sorry?
How many condos do you think you have right now?
Well, it depends how you define condo, right? I mean, we will look at low-rise and we'll look at individual residential. Like it still might be defined as a condo, but it's a row or something like that. I'm talking specifically high-rise condo. It's just too volatile for us to invest in. So I wouldn't have the exact number offhand with respect to which ones, those residential properties are actually, condo or not. Somebody might have it on the line here.
I remember there was one high-rise condo that was a blanket that discharged a couple of years ago. I don't remember too many high-rise condos being underwritten in recent years, but we can come back to that. And maybe that's a good point to start adding to the website.
They don't even bring it to me. I don't like them. So.
I can answer that right now. Actually, we have no high-rise condos in our portfolio. Right. We might have a townhouse condo or two, but I don't think I can count maybe 3 quickly in my head. So of townhouse condos, which is 80% loan to value or less.
Yeah.
Awesome.
Yeah, it's not the word condo that I'm afraid of. It's just the high-rise condos that and I got to be honest with you, it was something that my dad told me from day one. Never buy a high-rise condo. So I still don't. I still don't invest in them. So anyways.
Okay. I just wanted to draw out two, there were 2 or 3 lines in the financial statements that stood out to me as being variances from the percentages that were carried forward from the previous year. I'm just going to nip down to those spots. They're not big things, right? Most of the accounts year over year grew proportionately and didn't really strike me as something remarkable, except for accounts payable. Marvin, it just looked like a big year over year increase in accounts payable, and I know that you have the information. So do you want to dive into that for us?
Yes, as you indicated earlier, the main reason for the increase is just the simple fact that the assets under management increased. So you can see 2019, we had total accounts payable of 13 million and total liability, is 13 mil, and accounts payable is about 116,000. So, in relation with accounts payable to total liabilities in 2019 was about 1%. So for 2020, you see about $290,000 increase, but there's nothing wrong with that increase because in relation to the total liabilities, it's under 2%. So the main reasons for those increases related to accrued liabilities for broker fees, because we made accruals at the beginning of the year. Also management fees, again, which is based on assets under management, as well as prepaid borrowers, which again, it wasn't really a significant problem because of its relation with total liabilities.
So I think I also saw a bit of a jump proportionately in one of the smallest accounts that struck me, and that was office expenses. So,
Yes.
when the MIC has so little in terms of its profit and loss sheet to show, besides the income coming in and the dividends going out, when we see those tiny little office expenses kind of standing out, what page is that on?
It's the next one.
Okay.
You're on. Yep. Sorry. The one after. Yep.
There we go.
Page
So we
6.
have this tiny little jump in a tiny little account, but it stood out to me, and you did explain what that was to me.
Yep, it's director fees. So what we've done on the financial statement was we included it in the note, so note 7, just to highlight, I guess, a new line item. So what had happened in fiscal 2020 was that the director fees were paid out through the MIC, whereas in the prior year, it was decided that, or agreed upon, that we were going to pay it through the manager. So Mike was actually responsible for the director fees, which is actually not, you do see it within the industry, but I don't think, in my opinion, it's the standard. Usually the director fees are paid out through the MIC.
Right. So we know that the view is that directors are employees of the entity, so the MIC is the right place for them. Are there any other expenses that were moved from either the manager or the agent over to the MIC, other than the management fees?
Not off the top of my head that I can recall. Just again, because the expenses were so small and there weren't really any material ones that I can think of. But as you can see here, looking at all the other amounts, 7,000 were the management fees and office expense. So I figured if there was anything transferred over, it'd be marginal, like $20
yeah.
or so. Yeah.
No, I was trying to find something else that was a big increase, and
Yeah, I'm just going to add one other piece with respect to the board of directors honorariums there. These are independent board members. There's no family in there. It's important to note these days, right? Full disclosure, family members are not being paid to sit on our board. We have a very qualified board. We do have one employee that sits on our board. She's our VP of sales on the brokerage side, but all independent. So.
And Isabelle, I think that in terms of board meetings and our slate of board members, did anyone come onto the board this year? Did we lose any board members, or our board is the same?
The board of directors is staying the same this year. Yeah, nobody wanted to leave, and everybody confirmed that they were staying. So
awesome. Okay, and then I think I had one tiny little question about broker fees. So as we go down to note 7 in the financial statements, which relates to related party transactions, that includes anything that's paid to Advanced Alternative Lending, Advanced Capital Corp, and Mortgage Brokers Ottawa, I saw what I felt kind of like, from my gut, might be a surge in broker fees paid to Mortgage Brokers Ottawa, which seemed to be out of proportion to prior years. But Marvin, you dug into that one as well, and I'm just trying to get down to the right page, everybody. Almost there. Here we go. So it looked to me like this was a big increase in terms of the proportion of broker fees going to Mortgage Brokers Ottawa, which is related and connected. Are you seeing a greater percentage of business coming from Mortgage Brokers Ottawa? Are you still kind of balanced in terms of what you're originating externally?
From what I was able to see, was that the proportion is about the same. It's just the fact that there's more volume. So between third party and MBO, it's roughly about, I think it was 65-35 split, and it has been that way for the last 3 years. So I don't really see the proportion changing. Just the fact that
Marvin, is that deal flow or is that broker fees paid? And the reason I ask is strategically, I believe that Dan and Jen have been working to offload some of the broker fees that were paid in prior years, especially on second mortgages.
There was a change in policy during the fiscal year where the underwriting team decided to price certain deals differently. So the change that was implemented was on seconds after, I think it was April or May, I'm unsure, we weren't going to incur that fee internally. So I think it was more a pricing strategy, and that's pretty much the only thing that had changed. But because we do more first than we do seconds, you're still going to relatively see a comparable figure, even though we had a policy change. So basically, 75% of our portfolio is first. So that would represent the majority of the broker fees still staying on the books.
Right.
And
Yeah, sorry, Anisa, go ahead.
anecdotally, do we know how many of the broker fees paid to MBCI were related to deals originated by the people on this call? Or would you say the most of them were originated by brokers who work for Mortgage Brokers Ottawa who are not part of this management team? I think it's the latter. I think I should just explain really quickly to the listeners who don't actually work for the companies that Mortgage Brokers Ottawa has about 100 independent agents who work for them. And those 100 agents can submit a deal and they're the ones who get paid the broker fee. So that it's important to note that that additional broker fees paid to Mortgage Brokers Ottawa is going to those agents and not to the management team here.
Yeah, and also important to note, Mortgage Brokers Ottawa is MBCI.
Yes.
The official name is Mortgage Brokers City Inc. But yes, a couple of things there that I will add. One, a lot of our brokers have actually become investors, which is a great news story. So you typically, they will become investors, but they also become, more in tune to maybe look at our product first and see whether or not it's a deal that would fit for AMIC. So we are definitely seeing an increased amount of volume from a lot of our top agents because many of them have also become investors, which is a really, really good news story. But again, as Marvin had alluded to, simply the amount of deal flow that we're seeing now and capital coming in and churning that's happening, we're simply doing more business. So that number is going to grow proportionately with respect to the amount that we do for external brokers and the amount that we do for Mortgage Brokers Ottawa mortgage agents as well. And just to be clear on that point, yes, I mean, it is a related company. I am the president and CEO of both entities, but it is crystal clear. At first, on the first couple of days of business, people thought, oh, great, we have our own private mortgage investment corp. That's fantastic. They quickly learned that each has nothing to do with the other. And our underwriting is just as stringent, perhaps more stringent than what other mortgage investment corps will do with respect to due diligence when underwriting deals. In fact, most of them just know now, if it's not in this particular box, AMIC won't even do it. So they'll just go elsewhere and get it funded. But we do get the opportunity to pick the very best deals off the top, which, in my mind is a significant strategic advantage. And we also know who it's coming from. When we see those deals from staff. So we know that they're quality brokers, because if they're not quality, we don't keep them around at Mortgage Brokers Ottawa. So
Jen and I are kind of laughing because, I've had a couple of deals that have been declined by the MIC in the last couple of years. Yeah.
We just didn't like them. What can I tell you?
It's all right. It's all right. It's not personal. So the slide that we have on the screen right now is actually showing the point that you were making about the brokers and related parties and staff, putting their money into the MIC. So this is as of November 30th, 2020. So this is as of last Q1 2021. 47.77% of the shares are held by related parties, either you or you folks here on the call or your family and friends and close business associates. And I think that's a really compelling statistic, and that number continues to grow. It's a big increase over 2019. And Isabelle, I think we should get that comparative number up just so that we can.
You know what? I don't like seeing the screen either, simply because I'm falling behind here. So so I've got the slide in front of me here from December 31st, 2019. And President CEO family was 4.3% for 664,539. So I've gone down to 3.8%. So I'm falling behind my counterparts here, which means I need to pick up my boots and maybe work harder than I am now, perhaps. But anyway, so yeah, it's increased. The percentage has stayed relatively the same. So from December 31st, collectively, the amount invested from president, family, staff, agents, business associates was 7,358,681. And that's moved to 10,528,368. So, but the percentage was roughly the same, 47.5 previously. Now it's 47.77. But that's such a critical number in my mind. I love seeing this slide. because it shows that, the people that are closest to us, are not only supporting us with good quality business, but they're also investing with us as well. So, I love that slide.
Let's see what else.
Sorry, Anisa. I did want to add something quickly with the related party. I just wanted to say that the reason why you had brought it up is because we wanted to point out that it is a transaction cost, and it's something that external auditors will look at when there are related parties. So if you actually turn over to page 13 of that financial statement right now, and you're on page 17, I just wanted to show you the work that the external auditors do. So what they want to know is is this transaction? It's 2 more pages up ahead of you there, Anisa. Yeah, right there. So this chart is found on page 13 of the PDF file, which is the 2020 audited financial statement. So just to recap quickly, what the auditors do is they want to know the related party transaction. So in this case, what we're talking about is broker fees. So they do their assessment. They decide whether this transaction is normal for the business. So in the mix space, I did want to say that broker fees are part of a transaction cost, and the company would have had to incur that cost whether they paid MBO or a third party. So here, all we're sorry.
This is exactly the chart that made me see it, right? So last year we had 59,000 to MBCI and 52,000 third parties. And then this year it was 136 to MBCI and 42 to third parties. And I wanted to drill into this and see why is the proportion of fees so much higher for MBCI? But when we actually look at the deals, because of the business model change for the broker fees not being paid directly by the MIC, that's also part of this change. I wanted to drill into that.
Yep. And I just wanted to point out that, that it's normal cost, and we're doing what we're supposed to and breaking it out, nothing to hide, just showing what we paid externally versus somebody that's related. That's all.
Awesome. So let me flip back over to PowerPoint for a second and just touch on, a couple other points that we wanted to review. Primarily, just to go back to payments for just a minute, I wanted to, ask about you enter into contracts with people, and they're either going to make a payment or you're going to be setting up an interest reserve for them. And, this becomes more relevant now with more eyes on payment arrangements post-COVID. It looks like, 88% of your borrowers are making monthly payments by the number of deals that you have, and that 12% of your borrowers are prepaid from an interest reserve. And, when you're making the decision to make an interest reserve, is it because you think they can't pay, because they think they can't pay? Like, what is the reasoning behind creating an interest reserve from an underwriting standpoint?
Yeah, I mean, this is a tool that we've employed considerably more so since COVID. We've always used it. It's always been in our toolbox as a tool to be able to help people get over a particular event. But we've been using this a little more. And I'll give you one example. We had early on in COVID, we had an extremely successful hairstylist that had a great property, had great notice of assessments, provable income, a great spot, home salon, but obviously she was shut down completely. She was not able to work, and she was doing the right thing by not, quietly taking clients. But that's an opportunity right there to say, listen, we know, her success is going to continue. In fact, when they're able to open things up, she was going to be very busy again. And that has since been the case, actually. I think we've actually financed her out already, or about to. But in that particular case, we were able to prepay for 12 months and take those payments up front. And my mistake, it might've been 6, it might've been 12. Jen, do you remember?
6 months.
6 months. Okay. So that's why I caught myself. So it was a 6-month prepayment, and so this basically just helped her get through that scenario. So that's kind of a typical example of where we see there's an opportunity here to say, listen, don't worry about it. We've got lots of equity in the property. We are well protected, and we're able to cap those payments into the actual financing. And then they, hopefully at the end, the concept is we'll prepay it right now. We register the mortgage. We still do it for 115%, and then you pay us out. So that's been a very successful tool that we've been able to employ in order to get good quality business.
So it's 9 deals out of the current 74 that you have on the books as of November 30th. But when we look at the dollar volume, it kind of puts a different spin on it. It's $3 million of mortgages that are outstanding, 16% of the portfolio by dollar volume, where payments are not being made. And I guess I just ahead of maturity, what are the thoughts about monitoring this kind of group of borrowers?
Yeah, we always monitor very closely any of these accounts, and we're typically working with them. And typically what happens is they just flip to start making payments. So we never let that reserve completely run out and say, hey, well, listen, by the way, you owe us a payment for last month. Doesn't work like that. We're working with them and monitoring very closely. And what you will see is a lot of those mortgages that we do have on the books will simply be flipped out. So it's not like, listen, they shouldn't have had this mortgage in the first place. Those deals just don't get done with AMIC. So these are scenarios that we know they're either going to be, flipped to interest-only payment again, or they'll be financed out to an A lender. So.
Carrying on with that particular moment, in terms of how people are performing and how people can service their loans, I want to bring this slide forward, which goes into the type of employment held by the principal borrowers on each transaction. So since COVID began, this chart has been published on the COVID information page on the AMIC website. So our listeners can actually go to our website and read the history during COVID and see this chart in action. So 56% of your borrowers, your principal borrowers are, and this is by portfolio dollar volume, not number of deals, 56% are self-employed. And how, on the one hand, you could say that people who are self-employed have less cash flow certainty, but during COVID, I think we've seen a different outcome. And I want you to talk about that.
Yeah, 100%. I would say probably half of those self-employed people have contracts with the government in this city. That's a reality. So, because what's happened, when the government, cuts back and has a change in direction, those individuals simply become self-employed and then they contract to the federal government. So for us, self-employed individuals have not been an issue for us. Keep in mind, we steer clear of sectors that we know are being impacted, by the pandemic. And, if we did have an issue with respect to our self-employed portfolio, we would see it right now in NSF payments. There's no need to wait. But we know that the individuals that we're looking at, like we will do a lot of types of properties where individuals will purchase the property, they'll renovate the property, and then they'll flip out of it. So we do quite a bit of that. So they're not construction finances. We tend to, we dabble a little bit. We're just starting to look at some construction financing, but these are basically just, short-term flips. And we love those types of deals because we get to know the contractor very well. And we know that it's a short-term deal. So they're in and then they're out and they pay us out. So that's a large majority of it there. Jenn or Daniel, did you want to add anything on that piece?
Only just to add that self-employed individuals somewhat comes down to classification as well. So we would group dentists, doctors, medical professionals, depending on the structure of their employment, they would fall into that bucket as well. So we're not just talking about self-employed builders. Not that there's anything wrong with self-employed builders, but just to outline the profile of self-employed individuals.
Mm-hmm.
Right.
I also did want to say, though, that what I've noticed from my own data research is that self-employed individuals in the Ottawa area had a little bit more autonomy during COVID, where they were the ones that decided to take the risk as far as taking on, more business, within the COVID space. And when you get to other bigger markets like Toronto or BC, there's actually more corporations who, unfortunately, in those areas had probably, in my opinion, less self-employed individuals. So you tend to see that when you have different clients. So I've had clients in my past accounting experience who operated in BC and also in Alberta. And from what I can tell, it was just an irony that there's just a greater self-employed market here in Ottawa, which helped.
Yep.
A question just came to me, and Jenn, I want to ask you. So, yeah, the word student is coming out to me right there on the screen, and I recall that on occasion, Advanced would lend to people who own student rentals in the Ottawa U area and in the Carleton area. Have you seen any stresses related to COVID on student housing that you might still hold?
No. We do hold a few a couple of student rentals still. We've been paid out of a large number of them. They were able to move on. And the covenants are employed by the federal government and the school board. So they created some really good spaces for students, and we haven't heard anything about them having trouble filling them. They've been able to rent them out. They're fully furnished. They're actually sought after properties from what we know from meeting with clients. So no, there's been no concerns with respect to them being able to fill those properties.
Yeah.
And then leaping forward to valuation and talking.
I just want to add one other thing on that last slide there, Anisa. I mean, it's important to look at Ottawa's unemployment and how, throughout the pandemic, I mean, I think we went from a high of seeing about 9.2, that's Ottawa, compared to an Ontario average in August. I think the height was probably about over 12% unemployment. Ottawa currently sits at about 7.1%. We have, throughout the pandemic, Ottawa has always been one of the lowest unemployment rates. And as we can see now, so it started at 9.1 in July, 9.2, 8.6, 8.1, and now 7.1 as we start to move on a little bit. So, and as the pandemic becomes the new norm, and hopefully it's not the norm for too much longer, but those are very reasonable unemployment rates and compared to the rest of the country. So I think all in all, Ottawa has fared extremely well. And again, it goes back, you don't really need to look at the data and the statistics, to be honest with you, to determine that. You can look at the portfolio and how's the portfolio performing. And that will tell a picture right there. You can drive down your street and you can see, how's the economy performing? Well, you look at the for sale signs and you see the sold sign. That's how it's performing.
Yeah, and that's an excellent segue over to value, right? And I know that Advanced MIC reports its weighted average loan to value using the appraised value at the inception of the loan and the current balance. So as a mortgage moves through its lifetime with Advanced, the original value until it is reappraised is what's used. And I don't think you have too many mortgages that have been on the books for that long without reappraisals, maybe two, right, that have been on for a few years without having been reappraised. 2 or 3, Jenn?
Yeah.
Right?
Correct, yeah.
So, but what you do as an alternative is each quarter you order a report from Brookfield RPS that provides an automatic valuation. And Brookfield RPS is an appraisal management company and an appraisal company. So they're using, fairly decent data. And so, on this chart, which you present, the red bar, I'm not sure if it will highlight. Can you see my cursor at all? Okay.
Yep, we can.
So the red bar is the mortgage value. So that's total encumbrances. It's a first mortgage and a second mortgage if AMIC holds a second, and it's just a first mortgage if AMIC holds a first. So it's the total loan to value on the property. The red line is the original appraised value. And then what the gray line is here is what Brookfield tells AMIC the value currently is each quarter. So each quarter, AMIC is sending its portfolio into Brookfield and is getting back a report about what the current value of that property is under current market conditions. So I think any one of you can take this one, but
yeah, I'll take it. I love this report. Yeah, I mean, this is a great report. This is, it breaks it down by postal code. It's so detailed. It's fantastic. But this just gives us a high level look at, where real estate values are going in any particular area. Of course, we've got our own opinions with respect to what's happening in certain segments. And perhaps this would be a more valuable report in somewhere like Toronto, where you might have pockets that are doing well and other pockets might be struggling a little bit. But this is a great one for us to continue to monitor. As we know, our portfolio sits at roughly, loan to value about 75% on average is typically weighted average loan to value. But if we take into account the actual values of today's real estate, that number comes down quite a bit. So you might be looking at closer to 70, 72, 73, somewhere in there. So, we basically track this number, the weighted average, based on the day of the advance and what the value is and what we've lent on. So, but by having the Brookfield report quarterly, we're able to see exactly, because we see a graph with respect to, is something going the wrong way? So it's just basically an early warning system for us to be able to say, what's going on here? Maybe we need to pull that file out, have a closer look at it, and address any concerns, head them off now versus waiting till later. So, and we haven't had to do that. It's what we look for though, each and every quarter.
I did want to add though that Brookfield is a reputable company. They're third party, they're national, and this is what they do best. This is what they specialize in as far as valuation. So their reports, in my opinion, are of high quality.
Do you want to share the reports with the public?
That would be Mike's call.
Yeah, I don't know. If we are allowed to, I don't have any issues with it at all. So
we would have to read their agreement as well.
Yep. They might not like, because we pay for that. So
yeah.
They might not want us sharing it with everybody. Otherwise, then they're not.
That's it, you guys. That was my list of questions. So I'm going to stop screen sharing and I'm going to check in with the chat and see. Yeah, we do have one question. Okay, so Denis, actually, Isabelle, one of the questions is, was the document sent to the investors? If so, he hasn't received it yet. And I actually was incorrect. The reporting is going out, I think Isabelle said tomorrow or Monday. Isabelle?
Can't hear you.
I can't hear you.
Sorry, I have to mute myself. Yes, it's either going to be tomorrow or Monday, time permitting. But yes, one of those two, Q1 will be sent out. So annual reports were just sent out yesterday, and then Q1 are being sent out either tomorrow or Monday.
Perfect. I misunderstood that. So if any of our listeners are current investors and they haven't received their reports, I encourage you to email Isabelle or your dealing rep, and make sure that gets delivered to you. So I'm very happy to open the floor to any questions in the chat window. If anyone wants to raise their hand or ask a question, the floor is open. And
I will just add, while people are thinking about whether or not they have a question, I will add, Isabelle, you did have a few questions today with respect to the statements that you just sent out. So did you want to share something there, just so we're going to be posting this video on our website. So if you just want to give an update on that.
So for the people who were investors prior to February, you will see your annual statements have something on February 29th. So basically what we did was we redeemed all the share certificates and repurchased it same day. It's a net of zero. It doesn't affect your rate of return. It affects nothing. It was really just a change in model of our software we're using. And it was in the letter, it explains why we did that. So if you have any questions, because your statement will show incorrect contribution and withdrawal, but the balance is correct and the rate of return is correct. So if you do have additional questions, just contact me directly. I'm happy to explain it further. I'll probably end up calling you because it's easier in person to just, talk over the phone than via email. But that's kind of what happened. So I know I had quite a few questions, but going over it in a phone call will help you understand it.
Perfect. Thank you, Isabelle.
Okay.
And all we have is a thank you in the chat box from Denis. Thank you, Denis.
Well, thank you for the privilege of talking about our work to you. It's a source of endless interest for me to look at the data behind the MIC and to find new ways to try and find ways to improve the quality of the output of the data of the portfolio itself. And it's a privilege. So thank you.
All right. Thank you. I certainly appreciate everyone who joined us today. I know that we will be posting this, so I know that we'll get a lot of views either on the website or through our social media channel. to our shareholders. So thanks everyone for joining us and for participating.